Bond investors seem a worried bunch, don't they? Either their securities yield too little for the inflation risk ahead or too much, hinting at defaults to come. Central bank meddling has pushed all interest rates far too low, and well, just you wait. The end is nigh. Despite these concerns, one bond market which rarely loses its attraction is that for US Treasuries. At $13 trillion outstanding, it has plenty of space to accommodate everyone from the average punter to sovereign wealth funds. And though very low, at least one can still get a positive nominal yield with US Treasuries. Not so many government bonds in the world can even offer that. Consider that in 6 countries, including Switzerland, Germany, and Japan, their 5-year notes all offer negative returns for those investors holding the bonds to maturity. What's more important is that the longer-dated US bonds still have significantly higher yields than their shorter maturity brethren. Now, that should not come as a shock, really. Yields do tend to rise as maturities grow longer, partly to compensate the holder for any possible future increases in the interest rates. That yield difference in the longer maturities from the short, the yield curve, does move around over time. Now, that's a dynamic always worth watching, as it can give an early warning of problems ahead. Over the past 4 decades, the spread between the 2- and 10-year treasuries has almost always been positive. So what happens when the yield curve flattens or even inverts completely? Well, a flat or negative curve has only come 3 times in the past 30 years. Each time, a US recession and painful equity bear market has followed, though not necessarily right away. A year or more could pass before the problems come, though eventually they do. So what's happening now? Well, note that this time around, quantitative easing has confused matters, given the US Federal Reserve's regular bond purchases. But still, what we see is that this spread has fallen back to its lowest since the global financial crisis. And so, understandably, amber warning lights have begun to flash. Still, the yield curve remains positive, and the spread is at the 40-year average. Expecting the worst seems premature. Why worry?